Right, we'll get going. A few people might join us a bit later, but everyone hear me okay? Is that all right on the microphone? Yeah. Okay, thanks very much. Good afternoon, everybody. Welcome to this talk on 5 essential reports, 5 essential financial reports in particular, that I believe could be useful for any family attraction, anybody in this industry. My name is George Smith. I'm the Managing Director of KC Solutions. That's the brand name of our products from Cameron Computers. I'll mention KC Solutions a little later on, but in terms of my own background and why I'm stood up here talking about financial reports, my background is as an accountant. I worked for one of the big 4 accounting firms, KPMG. Started my career there working in financial audit. So I was traveling around hundreds of different businesses, ranging from owner, managed small business, right up to a few FTSE 100 companies. Our job wasn't just to check that they weren't doing anything too dodgy. We're also there to sort of learn about those businesses, see what they were doing well and what they were doing not so well. And financial reporting was a big part of that. And it wasn't always just those big FTSE 100s with all the resource and all the time that we're doing the most effective reporting. You actually saw some smaller businesses doing some really good and effective stuff. So I'm going to share a little bit of that with you today and hopefully see how you can apply that to your own businesses in this industry. Before I mentioned KC Solutions, and just briefly, what we do is we're all around integrating all the different systems in your business back to your finance system. We believe your business data is most important in your finance system. The reason we believe that, well, you've got to answer this question first. Why is financial reporting so crucial? In this room today, there's other people talking about different types of reporting, whether it's marketing, visitor attraction analysis, all hugely valuable, but I believe this is absolutely where you have to start your business. So why is financial reporting so crucial? Yes, it's nice at the end of the month, end of the year, to give ourselves a slap on the back if we've done well. It's nice to know if we've made some money and got something left over, but that's only sort of a result of it. To answer the question, I think we need to ask another question. Why does a business fail or succeed? Why do some businesses experience double-digit growth? Why do they grow and grow year on year? And why do some businesses that might be a year old or 100 years old fail? And I believe there's no rocket science here. There's just 3 simple core areas why a business either does very well or very poorly. Like I said, it's no rocket science. Sales, have they sold as much as they were supposed to? Are their sales going in the right direction? Costs, have they managed to control the cost in relation to those sales? Have they been able to manage their margins and been able to manage their overheads, their larger fixed costs? And then ultimately, through a combination of those two and some sort of wider context and some other factors, cash flow is absolutely what it's all about. That is why a business doubles in growth or a business fails. It's because either they've got cash to invest in to grow their business, or they haven't been able to meet their obligations, they haven't been able to pay that supplier or pay HMRC or whoever it was, and they've gone down. So we've lost some massive names this year in the high street and in the news of huge businesses, and we'd all love sales figures like House of Fraser and ones like that. Where they've gone wrong is they've failed to manage cash flow, so it's really important. And as you can see, hopefully that's not anything shocking to you. This is just core financial basics. So if we can all agree with that is where a business fails or succeeds, it becomes very obvious that the business data needs to be reporting on these things. And I use this very, very simple statement, and the last 2 words of it are very, very important. So you can only implement effective action around any of those 3 areas, sales, cost, and cash flow, if you have strong financial reporting, and it needs to be delivered in a timely manner. So when we go through these 5 reports, I want you to ask yourself, hey, could I get to that information? Is my business producing that information that I'd be able to report on it? But then say, well, how quickly could my team deliver it to me? Because if you can see some of these reports and think, yeah, if I give them 3 months after year end, they'll probably be able to get it to me. It's probably too late. We need to be acting on this information in real time, daily sometimes, weekly, monthly. So always think about that. Not just can I capture this data, but can I present it in a way that I can make decisions on it very quickly. So on to number 1, and we'll start with a relatively simple one, but I'm going to go into it in a bit more detail. Product margin analysis, and what I'm talking about here is the sale of stock. So if we've got hospitality areas, if we've got souvenir shops, retail areas, we're talking about the margin that we're making on our products. And at its most simple, it's a very simple calculation that anybody who's done anything with finance will know. Revenue minus the direct cost of buying that stock gives me my profit margin. But when we start delving into those 2 key components, there's a bit more to think about here, because out of the two, when we're working with businesses, I'd say revenue, people are pretty good at capturing the revenue. They want to know how much they've sold, they want to know how much they sold it for, but even still, when we try and delve into it at a product level, and can people report on revenue by product or by branch or by area, then it becomes a bit more difficult. But it's in the cost that I want to spend a little time here, because when you're calculating these sort of reports and we're trying to work out the profit margin of each product, the cost is really important. And the reason it becomes a bit complicated is because there's a number of legitimate ways that you could be costing your sales. All perfectly acceptable from an accounting point of view, but they give different results. So when I go through these, I'm not telling you right or wrong. What I want you to go back and understand is, which method are we using in our business? And crucially, are we applying it consistently? Because that's when you end up with real issues, when you're using different methods of costing your sales throughout the business. So I'm just going to go through this with a really simple example. We're buying one item in and we're selling it. So start of the season, we bought 1,000 units of this product at £2 a go. Before we open for the season, we decided actually we're going to need a few more, so we buy another 200. But by now the price has gone up to £2.50, but we've still gone ahead and bought them. We then open our doors for the new season and we sell 750 of them straight away. Brilliant. So how would we go around costing this? One of the methods, a very common method, is a simple average costing profit. And today's not around the maths, and I'm not going to spend ages going through this, but very briefly, we've sold these for £5 a go, so we're going to get £3,750 revenue. Everyone's very good at recording that. And then we need to work out the average cost of those products we've bought. So it's very simple in terms of 1,000 at £2, 200 at £2.50 means that this 1,200 has cost us 2,600. So 2,600 divided by 1,200, we've got an average cost of £2.16. Now if you're using any sort of mainstream accounts package, they'll be doing this in the background for you, so you don't have to worry about that accounting, the maths element of it. But what you need to understand is this the method we're using? So that would give us an average a cost of 1,620 for those 750. So we made profit on these of 2,130. So a very commonly used way of costing, and your finance system should be doing this in the background all the time, calculating these so you can work out for this product what's the margin we've made on those sales. So when things become a little more complicated is, like I said, there's plenty of other methods that you can use to cost that exact same transaction. So this is called FIFO, or first in, first out, and this is, even though it's not literal, it's based on the assumption that when you sell something, you're selling the oldest one you had in stock, the one that you purchased the longest time ago. So in exactly the same situation, we've got the same revenue, but it's gone and looked for the 750. It's taken them from the first 1,000, so it's costed them at £2 a go. So it's almost fulfilled that order with the oldest stock we have. And as you can see there, that will give us a cost of 1,500 and a profit of 2,250. So as I said, both legitimate ways of costing your stock and costing your working out your margins. But can you imagine if you've got these two approaches running side by side? It's not fair from a margin analysis point of view, or if you switch partway through the year, if you switch year on year. So what I want you to take away from this is, A, what method are we using? Is it appropriate? And I'd say if you're using either of them, very appropriate to your industry. There's loads of different types of costing methods, standard costing, what we do in manufacturing, things like that. But are we using one of them, and have we got it being applied by our system consistently? Because one of the things we often see is people are using a bit of both and things like that, and you can end up in a real mess. That's just a comparison of the two calculations, as you can see. So we've actually got a different profit figure on both of them. Neither of them are wrong, because eventually the costs will be flushed out for all of them. But what we're saying here is, if we're taking a reporting point of view now, we are going to have different figures if we were using two different methods. The reason I started with that margin analysis and getting to grips with how much profit are we making per product is because it should be the foundations and the starting point of a lot of other reports that you can use. And I'm going to go into another one that now takes that another level, and then you can start making some decisions and really putting it in context. This is what I call product contribution mapping. So we're taking that margin report, so we've got all our products, how much profit have we made on each one this year or this month, and then we're mapping them against each other. So you've probably seen these sort of quadrants before in all sorts of areas of business and outside of business as well. But essentially what we're doing here is we're saying revenue increasing bottom to top, and margin increasing left to right. So you take all your products and you put them in a quadrant like this based on that volume and based on that margin, and then you can start seeing how your product portfolio is performing. So again, we can do this in a souvenir shop, in a retail space, in a hospitality space. When we start talking about attractions and events and things like that, just save off on that, because I've got another area for those. This is things where we're buying them in and we're selling them on. So in that top right, we've got our stars. These are the biggest contributors to our profit and our product portfolio. We're selling a lot of them, the revenue's high, and they're high margin. So what do we need to do with them? Well, we need to look after them. We need to make sure we don't get complacent and these start to slip. We need to be giving them marketing support. We need to have a good place for them in our retail space. A flip side of it, and a different way of looking at it, is have we got anything that we're hugely reliant on here? Is there a few key products or services in our business that if they disappeared or something happened to them, it'd have a major impact on our business? So Apple did this exact analysis a couple of years ago, and the iPhone sat right up here. 70% of their margin came from iPhones a couple of years ago. They didn't have a problem with that. It was great how well the iPhone was doing, but they identified it as a business risk. So that's when we started seeing things like the Apple Watch and then starting to diversify. It was nothing to do with getting rid of the iPhone. They just wanted to have other products so they weren't as reliant on that top right star. Just to fly through a few of the other quadrants then, and the sort of issues they might bring or the behaviour they might trigger. Down in this bottom right, I like to think of this as like the products with potential. So the profitable products, the ones that we make good margin on, but we're just not shifting enough of them at the moment. So they're low revenue but high margin. Is there anything we can do with a marketing campaign? Is there anything we can do with the positioning of them in our retail space that could lift them up here? Could we even sacrifice a little bit of margin to sell more of them and still keep them in the star area? They're the sort of decisions you can start to make when you've got all your product portfolio in context. At top left, what I'd say with these is, these are the justification products. You've really got to test your team and get them to justify why have we got products in that top left. Yes, we're selling a lot of them. It probably means they're taking up quite a bit of retail space, but the low margins are not contributing a lot of profit to the business. Every stock item, every product you have in your business, it's not just the cost of buying it, it's got a huge opportunity cost, because that bit of retail space can't be used for another star, or it might be taking up valuable overheads in terms of store space, staff, things like that. So you've really got to justify those ones. There might be a reason for them. We might be acceptable with them because we just simply don't have any stars at the moment, but you've really got to justify them. And then the bottom left, this is really what you need to consider eliminating. We're not selling a lot of them, so they're using up space, they're tying up cash in our business, and we're going to talk through cash and stock a little later, but all that cash is tied up in stock. We're not shifting many, they're not giving us profit. Why have we even got them in the business? Why are they using up our precious retail space? There's a few scenarios where you might say, well, actually, they're a complementary product to our stars. As you know, we need to sell these to sell these, and then as long as you're justifying it and you're understanding why they're in the business, fine. But for all of your products, you want to be mapping them out and getting that story behind each one. Why is it there? Is there any way we can get more and more of them into the top right? So hopefully you can see the difference between report 1 and 2 there, that what we're doing is we're getting the core data from one, but then we're giving it some context with this second one, where we can actually start making some decisions and analysing information. So I mentioned this, and we're still focusing on profitability, we're still focusing on margins, but a profit centre is a distinguishable part of your business. This is something where you can directly attribute revenue and cost to it, so it's more than a product. In a lot of industries, location would be the way you'd use this, a region or a physical store or something like that. Where we see it a lot in the tourist attraction industry is it's a single location, but you've got almost a number of subsets in that business. You've got smaller areas, so we've got a cafe, we've got obviously our key admissions area, we might have some one-off events, Santa's Grotto, Halloween, whatever it might be, and then we've got a souvenir shop or a toy store or something like that. You can almost see all these as separate businesses within themselves, and you need to be analysing them at that level. So when I spoke about that idea of a timely manner, it's no good that if you're capturing revenue at the top level and you're getting an overall picture of your profitability, what you need to be doing is you need to be recording revenue, recording cost at this level, rather than having it at an overall and then trying to work back and it taking months and months of work and lots of spreadsheets to try and assess actually how profitable is the cafe. You need to be capturing your information at that level, so almost on a live basis we're reporting on the profitability of the cafe or whatever it might be. As a very simplified version of sort of how this can show a story, I've just got a business that started up over the last 5 years and turnover is booming. Everything looks absolutely brilliant in this scenario. We're up to 6 million turnover, and that's probably the basic financial reporting you're getting out of Sage or whatever it might be. Absolutely fine. Even better than that, profits are still rising as well. So again, you're probably getting this quite easily. How much profit are we making as a company? It's still going up, it's looking good. All right, it's plateaued a little bit here, but we're making lots of money. And there's so many businesses that stopped at this level. As long as things aren't going terribly wrong, they're quite happy to stop at this. That exact data, that £2 million worth of profit, if we could capture that information at a profit centre level, you can see how it could tell a very different story. So here well, first of all, it's explaining part of our growth because we've added new elements to our business. So it's all obviously important to understand why we're growing. Are we selling more of the same, or is it because we have diversified? So what started as a small cafe has now got all sorts going on with a gift shop. It's got Family Attraction ticketing. It's got a Santa's Grotto. So great. It's sort of telling a story. Other things we can see that the admissions element of the business has now become absolutely crucial. So almost like one of those top rights. Where we're hugely dependent on that for our profitability. But also what was hidden in those headline figures, and it's been a bit over-exaggerated for the purpose of this, but the gift shop is not profitable. It's actually making a loss, and it's reducing our overall profitability. Now, this doesn't give you the answers of what I'm supposed to do with this, but at least you can ask the questions. Is there anything we can do to improve the profitability of our gift shop? Can we lower overheads? Can we improve our margins? Do we accept that even if it breaks even, that's acceptable as part of the overall picture and it supports the admissions, etc.? That's fine, but you need to have the results on this sort of level before you make any decisions. So take away from this, are you capturing your sales and cost data at what you consider your profit centre level? And first of all, you've got to define those profit centres and then capture the data at that level. So those three were very much focused on profitability, so tying in with that sales and cost element of the 3 pillars of success and failure. This fourth one is all about cash flow. And when I'm doing these sort of talks, depending on who I'm talking to, I either focus on stock days or debtor days, which is how long it's taking you to collect money in from your customers. Due to the nature of our industry, I imagine stock days are probably a more important one to focus on from a cash flow point of view. Because what this is essentially going to give us is, for how long on average is our stock sitting on our shelves? What that means is that if it's sat on your shelf, your cash is literally on your shelf, it's not in your bank account, you haven't turned that stock around, that investment around, turned it into cash to work in your business and grow your business. There's various methods of identifying stock days. Depending on what system you have and the traceability you have, you can get down to an accurate, actual level of how long is that physical stock sat on my shelf. The nature of what we sell in this industry, I don't think that's needed. I think you can use a bit of an overarching average, and taking a calculation like this does exactly that. So you can apply it on a monthly basis or an annual basis, and pretty much what you're saying is, what's the value of my stock at the end of the month, end of the year? What's the cost of the purchases of that stock, either again over the month or year, and then times it by 365 or 30 for a monthly one. And then that will give you an average of your stock days, how long stock is sitting on your shelf. Now, what's a good stock day? It's a very difficult question. It totally depends on the product, the industry, etc. You know, in your hospitality area, I'd hope that your stock days are not weeks and weeks on end. If you've got fresh food, they're probably going to be longer in some sort of retail space. What I would say is, if you can, this is a really useful one to benchmark yourself with other people in your industry. If you've got a relationship where you can share this information with other similar attractions around the country, start benchmarking yourself and then benchmark against yourself. If you're reporting on this on a monthly basis, right, we've got a starting point now, at least we could start spotting trends over time if it's going up or down and do something about it. A real golden KPI or an aim that I'd give everyone is to find out what your creditor days are, how long are your credit terms with your suppliers. So if they're giving you 30 days or 60 days to basically pay for your stock, it'd be absolutely brilliant if you can get your stock days below that number. Because what that means is you're turning around that cash, you're turning that stock into cash before you've even had to pay your supplier. So you've maximised your cash flow efficiency. Quite difficult to do in a lot of scenarios, but if you can use that as a sort of golden aim, can we turn our stock into cash before we even have to pay for this stock, then you know you haven't got a cash flow problem there. So that one a cash flow one, and really easy that you should be able to get this information straight from your finance team or your accountant to be doing this very quickly. Like I said, if you are interested in tracking stock at a more detailed level, then you need to start tracking by batch or by serial number. Tends to be used more when you sell high value items, so we see it a lot in like technology, manufacturing and stuff like that. So I think this is absolutely adequate for general retail in your sort of industry. Okay, so the fifth area is overhead. So we've touched on margin, what was all about the direct purchase costs of our stock or in our profit centres, whatever it may be. But the overhead is a huge one, because I see this as one of the biggest risks, because there isn't that direct link to sales. It's the one that can end up creeping up. It's the one that can get businesses in trouble. Going back to when I mentioned we've lost some big high street names, it was around this in cash flow that they got too big for themselves. Some of my biggest clients when I worked at KPMG, in terms of revenue, were the least profitable, 100 million, 200 million turnover businesses that were at best breaking even, and it was because these overheads were in control. So in terms of reporting, what I want to give you here is an approach to overheads, and the key to take away from this is context. Overheads need to be placed in context, because on their own they don't mean anything. There's nothing wrong with growing overheads if our business is booming. So we need to think about context. So the first one is a simple overhead to revenue ratio. What percentage of revenue is our overheads? How does that stack up month on month, year on year? I'd expect if your revenue doubles, you're going to be doing something that's going to generate more overheads, more fixed costs, more staff, more space, whatever it might be. So always have that percentage and always be monitoring that one. And again, these are always really useful ones that you can benchmark with others in your industry. Share this information, these KPIs with each other, and see how you're comparing. So yeah, overhead to revenue are a really obvious one. Overhead to inflation. So inflation rates are really easily available. You can get these straight off the internet. The UK's RPI, what really gives you the underlying price rises across the country. Really useful, and I'd encourage you to do this almost on a line-by-line basis, rather than your total overhead figure. Take your utilities, for example. Take costs like that and compare them with inflation. Really useful from a budgeting point of view as well when we're trying to plan for next year, but how do our utilities sit against inflation? How does our salaries sit against inflation? Because if they're broadly in line, then we know that's okay, because it probably means our own sales prices are rising with inflation as well, and we're passing on some of that cost. But if your utilities over the last few years have raced ahead of inflation, and you haven't doubled the size of your site or something like that, then there's questions to be asked. There might be money to be saved, there might be something going wrong there. So again, another way of placing it in a broader context. And the final one I've got here is overhead versus headcount, and it's a bit of a funny one because headcount is a massive part of overhead a lot of the time. But again, it's a way of putting it in context. If we assume that we're recruiting for the right reasons and we're recruiting from we're growing, how do our overheads sit versus almost per head? What's the cost per head in our business? And again, can we benchmark that over time, against the year, against other businesses in our industry? So they're just three, but you might be able to go back and think about, well, what does drive our overheads in our particular business, in our particular location? Are there any other context areas that I could compare it to, and really push your finance team or your accountants to justify changes in overheads and be monitoring that? Otherwise, it is the easiest thing to creep up, because none of us sell stuff for less than we bought it for. We're quite good at negotiating margins and stuff, but it's these sort of like indirect costs that tend to sneak up. So really challenge your team on there. So that's it in terms of sort of 5 reports. Hopefully what you can see from there is I haven't given you any lists or pie charts or anything like that. What I've given you is more an approach to reporting and something to think about for each of these areas. And hopefully there's a few of these that you can go back and, like I said, speak to your finance team about and say, look, are we doing these? Are we monitoring these? And it's all about, a lot of it's about context and really justifying our products. We can all get too caught into the detail of of what we're doing on a day-by-day basis. But if this becomes part of our standard reporting, hopefully you can see how it can lead to actually some good decision making. Going back to that first statement I put on there about in a timely manner, really ask your teams this: A, can you get to this information at the right level? But how quickly could you get me that information? How regularly could you produce me this information? Because, you know, if we can only do a product contribution map at year end, and then we find out that there was a star up there that was only lasting for a year and now it's gone, we've missed a massive opportunity. Or if we've got something in the elimination, it's been there for a year costing us money, it's too late. We want to be reporting on these things pretty much instantly, and the systems out there now that do that. So obviously where we come in, that we're all about integrating the different parts of your business back to your finance system. So we have out-of-the-box integrations with all the Sage products and all of the main accounting packages out there for EPOS, stock management, e-commerce, online ticketing. And what we try and help businesses with is pulling that all together. We think the best place for your business data is in that finance package, because only then can you start doing reports like this. If it's sat in some ticketing system and a bit of it's sat in a cafe EPOS system, etc., you can never get that whole picture. So feel free to ask any questions or come and see us on stand 650. But yeah, thanks very much for listening. I hope there was one or two useful ones there for you to use. Thank you very much. Any questions? Well, you can always see me if you want.